Fortune favors the brave. Valerie, have you seen this tagline out there? I won't name the company.
Fortunately, yes, I have.
It's got everything. So I won't name the company, but they got everything as far as a marketing campaign. They got high profile celebrities. They got wonderful, cool ads. They've taken on arenas here just nationally. But there's something troubling with this tagline. And it doesn't have to do just with the segment it's in, which is crypto. You can find this in a lot of different financial segments as far as marketing campaigns. Each and every year, there's one deadly reason why individual investors underperform the market. You'll probably shrug this off when I tell you, probably already know it. It's behavior. Whether it's the Advisors Alpha from Vanguard, Morningstar's Gamma, the Dalbar study, we find behavior to be the biggest component for underperformance each and every year for investors. But there's something lurking within the subcomponents of this behavior category, lurking within the fortune favors the brave taglines as to why individual investors underperform, something that reaches into other facets, plagues our society in a multitude of ways. And today, that's what we're going to discuss, both through our own experiences advising, but also through various scientific studies, because this detriment is creeping within our decision-making patterns, all with the intent, as far as why we're talking about this today, of helping you make better decisions, both with your money and with your life. So my name is Mike MacKelvie. This is Your Life Simplified. I'm joined today by Valerie Escobar with Mariner Wealth Advisors. Valerie, how are we doing?
Great. I'm super happy to talk about this topic because It is everywhere.
It is. And there's this subcomponent I mentioned we'll get into within the behavior category, but I thought it would be good just to ask you, since you practice as a financial planner, obviously you work with a lot of people with wealth. Where have you seen your clients and just people in general struggle behaviorally as investors?
I could go with lots of different examples, but I think one of the biggest is thinking that they have found something that's super unique and that they are the exception in being able to find a really unique, rare investment option. I know when cannabis was first coming on the scene, that was a huge question I was constantly getting. Like, I learned about cannabis and how could I invest in it? And this is going to be the next huge thing. And they were under the impression that they were the only ones that knew about it. But it kept coming up constantly and over. And I mean, it's like all these things, it's a huge industry. There's tons and tons of companies out there trying to guess which one is, a gamble at best. And so really falling for that, I'm different. This emotional reaction is different and it's going to help me, has been one of the big fallacies that I've seen clients fall for.
Yeah. And, I think any advisor has seen similar instances and has similar encounters, right? I've definitely experienced many similar encounters. And I don't think that's, to take a dig at like individual investors or people in any ways. It's just that when you see repeatedly the same behavior, you start to notice it, right? And I don't think it's a surprise, again, that people get emotional with their money. That's not a surprise. You take, for instance, stock market drops. You're probably, and as I go through a couple just different examples here, you'll probably say, yeah, I get that. But just stay with me and see if these concluding sentiments apply to you at all, or if they maybe resonate with you. Why is it that so many individual investors struggle with their emotions when their portfolio drops? If we're rational agents like economics says we are, we would not react differently to gains and losses, and we should try to stay invested according to the probabilities, right? But all the data says that even the most significant, intelligent people will struggle with this. They struggle with staying invested through emotional or challenging times when the market drops. That's because loss hurts more than gains. The pain of losses seems to be more intense than the pleasure of a gain. We have an asymmetric reaction to the two. This is prospect theory, and Amos Tversky and Daniel Kahneman actually won a Nobel Peace Prize for this. It's also the underlying difference between traditional economics and behavioral economics. But that probably wasn't a surprise to you. Valerie, I mean, you would probably guess that most people would know that.
Absolutely. Right? Well, they think they know. They know rationally,
They think they know. Right. But if you were to just, and again, stick with me on a few just of these different questions. I want to run a couple different just sentiments by you. Again, we probably know that, people will react a little bit more emotionally to drops versus gains. But thinking more broadly now, answer these questions just personally for yourself. Think through these questions as I ask them and just see where you land. Again, there's no tricks to this. Just see where you land on these different questions. Am I more or less irrational with my money than others? Does the media influence me more or less than others? Do online advertisements influence me more or less than others? The overwhelming majority would say less to those three questions. Now, you maybe say more to one of them, right? But it's kind of like the driving fallacy that we see out there, Valerie, where
That's what I was thinking.
88% of people believe that they're better than the average.
I'm one of those. I am
Right.
better.
Yeah, I'm definitely one of those. Absolutely right. But what we're seeing here, and this is an important distinguishing point, right? Because that's statistically impossible.
Mm-hmm.
You can't have more than 50% be better than the rest if we're talking about averages, right? So that means that we're not only overconfident in our own abilities, but we talked a little bit there. There was one question in there about influence. We are often overconfident to the degree to which we can be influenced. We underestimate our ability to be influenced because, we don't like the idea of something else controlling us, right? This is sometimes referred to as the third person effect. It's somewhat similar to the illusion of invulnerability. And this is that subcomponent within behavior that is absolutely destructive to investors. Our excessive confidence in what we believe we know about both our abilities and ourselves. We get loss aversion. We understand that. We get that losses hurt more than gains. But we greatly underestimate our own ignorance. We underestimate our own ability to consistently behave rationally in this uncertain world. Everyone seems to view themselves as the exception. Mm-hmm. Valerie, where have you seen this?
Everywhere. I think one of the biggest things that I see with clients is that depending on where the market is, if it's been a bull market for a long time, then they think I am aggressive and I love this. And I know it'll crash eventually, but I'm going to weather the storm just fine. And so one thing we always say is that the time to gauge somebody's risk tolerance is during the crash. Like, where are you really thinking that you are at that point? Because that's when you are going to get much more in touch with what your emotions are. We were talking a little bit about social influence, and maybe we're saying, celebrities, whatever, I don't really care what they have to say. Most people do. But I see sometimes that clients are saying, my friends are outperforming the index. I want to outperform the index. And we go back and we say, but the financial plan doesn't actually require you to outperform the index by much. We can just stay in line with the index and we're fine. Plus it keeps you safer, right? But then they're just so influenced, but I want to have something to brag about. I want to have something to talk about. And so then that is their driving, motivation as opposed to being able to meet their financial goals.
Yeah. And I think, with this, like, as far as like our ability to be influenced, right? Again, we underestimate that. I think what happens is over time, it chips away at us. So it's not like you see one ad and you're like, all right, I'm going to put all my money into this investment now, right? If you think of like COVID, for example, and how that progressed, right? First it was, hey, we have this virus over in this different country. It wasn't as big a news, but as things started to come out more and more and more, right? We saw markets dropping and it just chipped away at a lot of just different emotional, let's just say, I'm going to turn off my notifications. It just chipped away at our emotional ability to, I guess, just stay strong. As far as like the fundamentals of what it is, maybe we had a long-term investment horizon and, it just has a way of kind of just chipping away at us. If I've said that enough already.
It chips away. And that is very true.
Yes. Well, you just don't know your future self. You don't know how your future self will behave in a new
Right.
chaotic environment. We'd like to think we know that person, but you're sitting in a rational place, a very comfortable place a lot of times when you're thinking about these things, but you just don't know how your future self will behave in that new chaotic environment that you will likely be in at some point in time in your life. You don't know how you're going to react from an emotional stance as far as just investing your money. But, you know, I think the first step is, okay, well, where can you spot this overconfidence? Because again, if Daniel Kahneman, who's probably the most famous behavioral economist there is, could fix one thing, he says it would be overconfidence. So where can you spot that, Valerie?
Again, during those bull markets, right? When somebody says, I know that I am aggressive, and then also thinking that you can pick the right stock, picking individually which one's going to skyrocket. Or just saying, I don't need to take that conservative route because I want more. And, greed is something that kind of feeds into that as well. And saying, I don't need more. We've decided I don't need more, but I want more because the trajectory is going that direction. And so I'm not willing to get out of the game because that emotion, is just overwhelming.
Yeah. And, prospect theory, again, if we were to summarize it, what they found is it was roughly about 2-1. So Tversky and Kahneman. So like winning $100 was about the same emotional impact as losing 50. That's really telling. Because if you asked most people, how they felt in a good, comfortable state, they probably wouldn't exaggerate it to be that much. At least most people wouldn't, right? But I tend to find overconfidence a lot of times in the feels, right? So I get the probabilities say I should be invested, but I feel like we should be in cash right now. I know that the models say I should diversify away from my company stock, but I feel great about where we're headed. The feels, that's often, I think, a good indication that overconfidence is maybe seeping into your judgment.
Yeah.
So,
And I think too, acknowledging that we are humans and,
yeah.
just saying I will be emotional is very important. One of the things that I try to do with clients is, acknowledge that and leave room for it. One of the biggest things that comes up is mortgages, paying off your mortgage. The math tells us that if my mortgage is 3% and my investment the expected return is 6%, you put your $500,000 into the market and not pay off the mortgage. Emotionally, people are just not as happy with that. Some people, right? And if my client is expressing and showing any kind of resistance to that idea that I'm going to let the math work for me, we will plug into the plan and say, okay, well, what if we do use that money? We pay off your mortgage. Are you still able to meet your long-term goals? If the answer is yes,
Right.
and they can sleep at night, then we're going to let us be human, pay it off, and just go on our way. I think that works so much better than trying to fight against yourself however often it's keeping you up that you have this mortgage, to just acknowledge and say, I'm going to go ahead and let myself be here, do this thing. And then in other places, maybe I can be stronger and stick to the plan much better that way.
That's a great point. And I think what you're getting at there in a lot of ways is, it's not about, as an advisor, just explaining probabilities to people.
Exactly.
Because probabilities won't get somebody to behave in a rational way if they understand them, right? I mean, there are countless examples of this. And so I think a lot of advisors maybe struggle with that because they just say, well, if I explain this to them and it makes more sense theoretically from a statistical stance, then they'll do it. That's just obviously not the case. Again, we're human beings. So I think I wanted to give some steps just to how to combat this, like just some steps that you can take to maybe kind of put some roadblocks in place, just to maybe check your behavior. But again, you probably view yourself as the exception. But if you were to say, hey, I might be privy to being overconfident at different times, and that just hasn't really worked out for me in the investment world, or maybe you don't know that. Again, there's times to be confident in life, but with managing money and just picking different investments, overconfidence, again, has not been particularly great to investors. So the first step, I would say, is slowing down. So be wary of this Dunning-Kruger effect. So this Dunning-Kruger effect is people with the least amount of experience in a given domain tend to overestimate their abilities more than anyone else. Okay. So I think that really ties into the second step, which is assume there's more to this than you know. So first, take a breath, slow down before you decide to make some change. Second would be assuming that there's more to this that you know, more than you can figure out in a day, a week, a year, right? And just kind of fall into that stance of, okay, there's people that are experts in this field that spend their entire lives on it. That's probably for a reason. It's not because you can just pick it up in a day or a week and just figure it out, right? You might go into the doctor and realize you don't have it figured out from WebMD. The doctor might point something out that you don't know. The third step would be understanding the consequences, because there's risk to everything. So if you decide to invest in some new thing, obviously that takes away from your ability to do something else. Money is finite, right? So understanding the consequences, that's going to be a challenge if you're not doing this every day for your entire life as an expert, to understand all the different alternatives. Again, I think that's really part of what being an expert is understanding what the alternatives are and essentially knowing your limits, which they quote in that Dunning-Kruger study is one of the biggest differences for experts is just knowing your limits in a given domain, right? The fourth step, ask for real feedback. So, hey, I'm probably missing something here. Can you see if there are holes to be poked in this logic? So going to somebody that hopefully is an expert in this field, not just Reddit or your buddy, but asking for feedback from somebody that is an expert. Hey, what do you think of this? And just being open-minded with it, that there is the potentiality of you missing something in this field. So, Valerie, do you have any comments on that?
I think that that last point is exactly the kind of relationship that we try to form with our clients, right? We need to be able for them to speak open, honestly, and bring to us that, this is my thought, this is where I'm feeling, this is where I want to go. What am I missing? And just being able to say, sometimes I am going to be emotional. And we always encourage clients, like when the markets are correcting, when things are feeling off balance for you, when you have, this once in a lifetime investment opportunity, call us and let's talk through it. Because the easiest way, I think, to identify your irrational behavior, overconfidence, is to have a conversation with another party. And especially an expert is helpful, or somebody that is in the know and it's their profession. And so, we have to acknowledge, all of us, that maybe we're not the 50% driver experts that we think we are, and just, allow for that room.
Yeah. And I think, again, it just comes back to just having some vulnerability and saying, okay, like there's a difference between vulnerability and weakness. Mm-hmm. It is not weak of you to say that there might be more to this than I know. But I think in a lot of ways, our society rewards overconfidence. You see like sports reporters, different types of anchors, and they speak in absolutisms, right? Mm-hmm. It's like, he is absolutely the best player in the NBA. That gets them an audience a lot of times, because in a lot of ways, our society likes overconfidence. It at least carves off something to be debated. But if you pull it apart, they're usually talking about something subjective. It's not objective truth. There are very few objective truths, but they're talking about something subjective. Because they're speaking in absolutism, they maybe gain an audience off of that. So again, I would probably steer away from that, which is difficult at times, because that, I think, is actually a little bit a form of weakness. It's not, there's nothing wrong with being vulnerable, right?
Yep. So, and same thing, categorizing yourself as brave. I am brave, then I'm going to do, I'm going to go ahead and jump off of this bridge.
Well, I want to be brave.
Yeah. It's like brave, but now you're no longer on the bridge and you're free falling. Like,
I don't want to not be brave. Yeah. And they know that. And again, that's why they're building marketing campaigns like this. They know that attracts a certain type of person, right?
Yep.
In a lot of ways, the majority of us. So, in conclusion, again, overconfidence here, I see that as the biggest component within behavior as far as why a lot of individual investors tend to underperform the market. There's nothing wrong with saying, again, there might be more to this. So hope you enjoyed today's episode. Make sure to hit that subscribe button just wherever you might be listening to this to follow along for more content from industry professionals here at Mariner Wealth Advisors. Take care.
Thanks, everyone.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.